Rama, you are there?
Yes, sir.
Can start.
Good evening. Good evening, when and all present here.
Yeah, good evening.
I would like to take an opportunity to welcome all the participants to the third webinar of the series, Banking Matters, hosted jointly by Southern Indian Bank's Staff Training College, SIBSTC, and VRDDHI Consulting and Training Services. I would like to take an opportunity to invite Mr. Ajay K. Anand, Managing Partner of VRDDHI Consultancies, to welcome the participants. Over to you, sir.
Thank you, Rama Devi. Good evening to you all. Welcome to you all for the third webinar of the series, Banking Matters, jointly hosted by SIBSTC and VRDDHI Consultancy and Training Services. Bank risk management in banks, as we all know, has changed substantially over the last several years. The future of bank risk management is one of the important topics today. With pandemic, global regulators, world economic changes, disruptive intervention of technology and innovation, and the world now on the early stages, with the world now on the early stages of Industrial Revolution 4.0, we need for more detail, demanding capital, leverage, liquidity, and funding requirements. Higher standards for risk reporting is emerging. We are also observing impact on various dimensions in business operations, business models, and in all segments, which are also connected with the banking sector. The focus is on continuously building resilience against market shocks to protect the interest of all stakeholders. We are also seeing the emergence of artificial intelligence and machine learning in the area of risk management. We have today with us Dr. K. Srinivasa Rao, former General Manager, Bank of Baroda, to deliver the keynote address on the topic, Emerging Nuances of Risk Management in Banks. Welcome to you, sir.
Thank you.
Welcome to KLS and Rao, Principal, Southern India Bank Staff Training College, Bangalore. Thank you for initiating this unique webinar series. Welcome to you, sir.
Thank you, sir. Thank you, sir.
Welcome to you all senior executives from the banks, Reserve Bank of India, banking professionals, bank employees, and the banking faculties also. Welcome to you all to this webinar. Thank you very much.
Thank you.
Now, I invite Ms. Princy of Administrative Executive of VRDDHI Consultancies to introduce keynote speaker, Dr. K. Srinivasa Rao and Mr. K.L.S. Rao, Principal, SIBSTC, Bangalore. Over to you, ma'am.
Thank you, Rama, ma'am. Good evening, everybody. Once again, a hearty welcome to Webinar 3, Banking Matters. May I welcome our keynote speaker, Dr. K. Srinivasa Rao, former General Manager, Bank of Baroda. Sir teaches risk management as an adjunct professor at Institute of Insurance and Risk Management, Hyderabad. He is associated with training executives of NIBM and IIBF, Asian Institute of Technology, Bangkok. He shares his views on monetary and fiscal policy perspectives in financial dailies and runs a YouTube channel on banking and finance. Sir has also penned blogs for Times of India that can be accessed from the public domain. He is also the proud author of 3 books on banking. We welcome you, sir.
Thank you.
We also have with us Mr. K.L.S. Rao, Principal, Southern India Bank Staff Training College, who needs no special introduction. This visionary leader is a brainchild of the Banking Matters webinar. So we must say this, that these webinars have added a lot of value to its participants and is a feather in your cap. We welcome you, sir.
Thank you, madam.
May I take this opportunity to also welcome Mr. Ajay Kaungal, Managing Partner with the CTS. Sir has been very actively doing everything in his might to add value to the life of banking professionals. He's retired from Punjab National Bank as AGM. His institution, VRDDHI CTS, is actively involved in organizing webinars, online sessions that add value to industries, MSMEs, entrepreneurs, and banking professionals. VRDDHI conducts online sessions for JIIB and CIIB. It has also organized webinars from time to time titled Hand-Holding MSMEs During the Pandemic. VRDDHI as a brand resonates with stability and growth. We welcome you, sir.
Thank you very much.
Yeah.
Over to
we-
you, Rama. Thank you, everybody. Over to you.
We have Mahabaleshwar sir, Chairman, Karnataka, Managing Director, Karnataka Bank. Welcome to you, sir. Welcome to you to this
Thank
session.
you. Thank you. All the best. Thank you.
Thank you.
Thank you, ma'am. Thank you, ma'am. Now, I would like to invite Dr. K. Srinivasa Rao, former General Manager, Bank of Baroda, to deliver the keynote address on emerging nuances of management in banks. Yes, sir.
Yes, excuse me. We have KLSN Rao to make the presentation of
Yes,
the
sir.
topic,
Yes,
please.
yes, sir.
Yeah.
Topic presentation is there.
Yeah.
Yes.
Please.
I would like to invite Mr. KLSN Rao, Principal, SIBSTC, Bangalore, for the inaugural address and introduction of the talk of today's webinar, Emerging Nuances of Risk Management in Banks. Over to you, sir.
Thank you. Thank you very much, madam. Thanks one and all. Special thanks to our chairman, Sri Mahabaleshwar Rao, Professor Srinivasa Rao, Mr. Ajayan. Thank you very much. In fact, the risk, this word has emanated with the deregulation of Indian economy, LPG, liberalization, privatization, globalization. Yes, the economic reforms has brought in a lot of changes to the banking system, also brought in liquidity, abundant liquidity to the banking system. Alongside came the risk. Since 1992, though 1988 Basel I Accord was issued, where in India it was implemented in 1992. Subsequently, an improvement over the Basel Accords were made in 2004, 2010, that is Basel III. And in fact, in December 2017, Basel has issued one more communication. In fact, it's called Basel IV, familiarly known as Basel IV. All these guidelines are intended to take care of the risk emerging at different points in time in different dimensions. Therefore, being aware of what is happening in and around would enable the banks to take informed decision. Risk does not necessarily mean no decision. No, risk means decision backed by information, backed by data, backed by a proper understanding of the whole thing. So in this direction, knowing about the risk management, particularly now, after this pandemic, nobody had thought that this pandemic has taught us many things. So under the circumstances, in fact, I had a talk with Professor Srinivasa Rao also. He also felt that with lots of changes happening, when financial problems of 2007-8, then subsequently unexpected, the corona, all this has led to a lot of emerging risks. So to cover these aspects, can we have one session? Dr. Srinivasa Rao readily agreed, and welcome you, sir. And I will not further waste my time. So over to you, sir. Thank you very much.
Yes,
and over to you. I will mute myself to listen to you, sir. Thank you.
Yes, thank you, and good evening, and welcome to all the participants and the dignitaries who are connected to the webinar. Now, can I share the screen, please?
Sure, sir. Sure, you can do that.
Yeah. You are able to hear me?
Yes, sir.
Okay.
So you're already co-host. You can do that, sir.
Yeah, co-host. No?
Yeah.
I'm not finding that. You're able to see this?
No.
No. Because
So click on share screen.
yeah, share, I wanted to share the screen.
Yeah, you can click share screen, sir.
But I'm not finding that icon.
And below the last 1, 2, 3, 4, you can see share screen. You're on full screen, no?
Yeah.
Below you can see your videos. Then you can see security, participants, polls, chats, share screen also there.
I think I am finding I think your people have put this.
Is it there on the, no, that is removed. Nothing is.
No, but it is still there. That's why I'm not getting that.
Rema, have you removed that screen?
More than meetings, explore what is possible with Zoom. That is what is coming here.
No, sir. You can just press share screen, sir. Share screen will be below.
Share screen is not coming here. Okay.
You can reduce. Are you seeing the participants, sir?
No, I'm not finding this. Just 1 minute. Huh?
You can click on the Zoom icon is there, sir? Is it full?
Yeah.
You can double click on that.
Yeah.
Princey, can you guide him, sir?
Yeah. Share screen.
Yeah. Now you can do. Yes, sir.
You're able to see?
Absolutely. You.
Okay, fine.
Please proceed, sir.
Yes, sir.
Okay.
This is fine now. Yeah, I think all of us are able to see.
Welcome to all the participants and thank you very much. And now why we wanted to cover this particular topic of emerging risks is we were very much familiar with how to manage our risks, like the most common risks that come to our area is credit risk, market risk, and operational risk, and the risks associated with them. So we know very well how to manage them, and maybe that some of the tools that are there already and the regulatory dimensions that have been in practice in banks and the checks and balances that are already there, we are very much familiar with that. But now the pandemic of 2020 onwards changed the entire ecosystem of risks, and now we were lending when the borrower was good, like we were told to lend when the borrower is good. But now after the pandemic, we have started hand-holding them, even if like emergency credit facility that has been given by the government, and we have started using TLTRO, that is a targeted long-term repo funds, and we have started hand-holding the so the entire risk management perspectives which we were used to has undergone a huge change, tectonic change, I would say, and the integration with the rest of the economy. Its impact has become much more glaring now. Like earlier also, like what Mr. Rao was telling, the principle that we know how to manage the external risks because they were normal risks. But now after the pandemic, and added on to that, the geopolitical risks arising out of supply side disruptions on the one side and the war on the other side between Russia and Ukraine, and then inflationary forces that are in major economies, and the way the currencies are behaving, like behavior of the currencies of emerging market economies, they are dipping, they are depreciating, while dollar is appreciating very fast, putting the entire risk per scope in a different pedestal. So that has triggered that we need to reset our priorities and reskill ourselves and understand the perspectives in a different lens, so that we are in a better position to take the economy from the current level and support the economy, like what we have now seen. The credit growth is rising and deposits are falling. Banks are for the first time, there has been a deficit, and now RBI is thinking of pumping some kind of liquidity into the system. So the entire trajectory of risk about which we were very familiar in the earlier days, that has already now changed. And this is as far as banks are concerned. Now, on the other side, the corporate sector, which was highly leveraged for some time, now they are deleveraging their balance sheets. They are consolidating their balance sheets, and they are now working on a different pedestal. And the demand for lending has now started looking up, and banks also have started shifting earlier from corporate sector to retail sector. Now retail sector to corporate sector, we are again coming back. And then now we are going to very soon see the new EXIM policy that is going to come up for the next 5 years. I think it is going to be announced on 29th or 30th of this month. And the monetary policy is also to be reviewed, is about to come. And with the background of the interest rate rise that we have seen in the rest of the world, I think RBI also will have to fall in line. Otherwise, a lot of stress will be there. So taking all these perspectives in mind, we thought that we need to re-understand the dynamics of risk management, and that is why we need to discuss on the these aspects in particular, because they are going to alter our understanding about the risk. Now, when we understand risk, then we know very well that we are very familiar, but we will introspect once again what is risk. Risk is simply losses arising out of uncertainty and due to unexpected outcomes. And if our income levels are lower than the expected levels, then there is a risk, and it is usually expressed in financial terms to provide a quantification of the risk. So these things we know very well. But what is more important is, if the actual returns from business are less than the planned income, then we are exposed to financial risk. So let's understand that in that perspective, that financial risk is the possibility of losing money. Now, why all of a sudden, like Mr. Rao was telling, that why risk? Because now we have the ability to manage the risk. Maybe 20 years ago, we had very less ability to manage the risk, but now we have a huge capacity to understand the risk and manage the risk because of the technology that we have adopted in the last 1 decade. So that core banking and the data that we are collecting and we are pooling and we are analyzing and we are taking informed decisions now. So, and since it is now possible to manage the risk, we need to understand it in a much better perspective. The possibility of managing the risk. So let's understand clearly that risk was there, is there, it will be always there, so long as there are businesses in the system. But the way in which the risk is to be managed undergoes the change because of change in the macroeconomic dimensions, market intelligence, and external sector link with the domestic sector, and how domestic sector is influenced with the external sector. These things will be making a lot of change as far as quantification of risk is concerned. Now, if you connect the developments with the financial risk is threat of losing money. So that everyone knows the way in which Sri Lanka was has been facing, and how the fallout of different institutions, they were in trouble for some time, and then now many of the economies, they are not able to meet out their commitments of external debt because of the local changes in the macroeconomic dimensions. So it's very important for us to find out ways and means of how to reskill our people, reframe our policies, reframe our internal processes, and what we call normally we call internal guidelines for different SOPs, standard operating procedures, and internal manuals, all these remaining same. I think we need to work on them so that they are, if you can refer to the RBI's recent report on currency and finance, it is a research-based publication. It very clearly says that the impact of pandemic is going to last up to 2033-34. Means next 12 years, we will be having the lag effect of pandemic. Now, on the top of that, we have this geopolitical risk of war and the way in which the sanctions have been imposed and how the different economies are trying to work despite the sanctions, like RBI has introduced the settlement of rupees in domestic currency with trading partners by opening a separate what we call Vostro account, separate special Vostro account opening and then settling the transactions through rupee. All these are innovations that are coming up with the need for managing the nuances of the risks that are now causing concern to the regulators as well as to the banks and also to the corporate sector. Now, whenever we talk of risk, we should not talk of risk only for banks because we are there for the customers. If the customers are also in a different risk trajectory, we need to understand their risk as to how they are managing their exchange rates and how they are keeping themselves hedged and how the interest rate curve is going up and how much of burden will come to them. Are we to while reviewing the loan accounts, are we to look at these aspects in redesigning their repayment capacity because they may not be having the same kind of capacity which they were having 2 years ago? So these are all some of the things which we need to disseminate down to the line management so that they are in a better position to align the what you call sanctions and repayments and things like that so that our credit risk is not jeopardized very adversely because of the changes. Like Mr. Rao was also making a mention about that. I just wanted to put this ladder here because it will be very relevant to the newcomers as well as to the seniors as far as recollecting what has happened in the risk trajectory. Credit risk has been recognized in 1988, market risk in 1997, operational risk in 2004, and after the Lehman Brothers fallout, that is global financial crisis, Basel III has been brought out in 2010, and now, as Mr. Rao is telling, is already Basel IV is in working, which is also known as Basel 3.2. So that is the new norms that are going to come as the risk environment changes. New innovations will take place. Regulators will come out with tightened regulations, like now PCA, that is a prompt corrective action, and the entire framework has been changed recently, and it is now extended to NBFCs as well. So these are all some of the things. When the regulators tighten the regulation, then the cost of regulation, and then its impact on the corporate sector and the borrowers, those things have to be taken into account. And now capital is one more area of challenge for the banking sector. Though at present, the capital adequacy ratio is comfortable, but ICAP policy need to be reviewed in the light of the developments that are now taking place. So these are all some of the what you call alerts that are coming in the environment, which we need to capture and act upon them and reskill our people, re-inform our people, communicate correctly to their line management so that they are in a better position to change, because we cannot do the business in the same way in which we used to do the business before 2020. And maybe that in the coming years, we will have to change the whole way of understanding the risks and the understanding of geopolitical risks. I think we have Ukraine and Russia war, and it is going to prolong, and it is now nothing is in sight as far as the peace is concerned. And on the other side, there is China, Taiwan, and then US. All these geopolitical and diplomatic relations are changing. When the diplomatic relations are changing, it will have some impact on the businesses of our entities, and they also travel to the banking system, which we should be mindful about. And action is required by the subcommittee of the board, by the ALCO, that is the Asset Liability Management Committee, Asset Liability Management Group in the bank, and then we will need to understand the structural liquidity very minutely and see how our different time buckets and what are the deficits and how to plan out, because the cost of money is going up, and it is now going to go up much more in the coming 2 quarters to come, because the inflation is still at 7%, and we will definitely be targeting to bring it down. And that will since the rest of the major economies, they are in a state of nearer to stagflation and inflation, and nearly what you call a double-digit inflation. In that condition, they will be raising the interest rates very fast. If we do not raise, then the flight of capital, that is FPIs, that is financial, our investments will go out, and then it will have a pressure on the rupee. So these are all some of the things which we need to understand. It is not the treasury dealer who will be doing this job. Treasury dealer is meant for managing the day-to-day liquidity mismatches. But how we are going to manage our rise in the CASA on the one side, dip of term deposits on the other side. Earlier we used to have, we used to celebrate when CASA goes up. Okay, but when the CASA goes up beyond a threshold, it points out towards a behavioral change of the society, that the society doesn't want to. So if that is the case, then how we are going to manage our liquidity, our products, our pricing, our risks, and our processes, our customer satisfaction, customer protection, all these things will have an impact that need to be seen. So risks from supply side disruptions also will have an impact on the adding to the geopolitical risks, because supply chain, though earlier we were thinking that inflation is a transitory matter and it will cool down the moment the supply side is restored, but because of the China's zero COVID policy, they had to shut down many of their product lines, as a result of which many of the supply shrinkages has taken place, and it has not restored. In the meantime, this Ukraine and Russia war has created a new set of challenges for the banking system and also to the corporate sector. Whenever I talk of risks to the banking system, immediately I talk of risks to the market participants as well as to the corporate sector, for whom we are designed to serve. If you are not serving the customer, then I don't think we have a business to do. So it's very important to understand their constraints and realign our working system to see that both are in a better risk management capacities, and in the short term, it's very difficult to reskill the people. Here, the role of staff college comes, the role of internal training comes, the role of internal branch managers come, because branch managers are the mentors for the line management as to how they need to look at these new perspectives and understand it. Now, while this is on this side, the other side, the VUCA, that is the volatility, uncertainty, complexity, and ambiguity, that is also rising on the other side because of the stiff competition that we are having. Take any area, whether it is fintech, because the RBI governor was talking on the other day about the fintech. When you were telling about the fintech, we need to have a webinar. That's very much essential, because the connect between banks and NBFCs, including fintech, neobanks, and the small finance banks, payment banks, cooperative banks, and RRBs, all these will have linkages, and one is dependent on the other, and we need to drive the synergy of these institutions so that we are in a better position to face VUCA environment. That is volatility, uncertainty, complexity, and ambiguity. So these have to be disseminated down to the people, because if you see the banking system, now chief managers, AGMs, and all these people, maybe they are well versed with all these aspects, but the touch point for the customer is the employees who man the branches. So however best we do the digitization and digital banking and things like that, but the decision lies in the supervisory people and also in the officers and senior managers who need to be well versed with that. So rising risks in financial sector, a normal growth induced risk we can manage. Like, but if VUCA comes, if geopolitical risks put additional stress, if COVID impact lingers around in many of the economies, may not be to India, but when it is hitting some other economy, it will travel to us. So that we should be very watchful about that. So these are when we are moving, we are now the 5th largest economy. That is what is in the every headline we are hitting, and 3.5 trillion. We are moving towards a 5 trillion and then maybe 10 trillion. And we want to, by 2047, by 100th year, India at 100, we want to be the developed economy that needs a 25 trillion to 20 to 22 trillion. So if we work with the same pace and with the same way in which the risks were managed earlier, and we keep the same rule book and blue book with us, I think we need to have a different perception as far as managing the nuances of risks are concerned, and how to work with other financial intermediaries who are equally active as far as the financial system is concerned. And banks are active, no doubt, but NBFCs are also active. So we need to derive the synergy out of that. That is why RBI has permitted co-lending of with the NBFCs. And now how much we have tapped that resources in managing our risks, or how we have transmitted the risk, because they are less regulated. So there is an arbitrage, though RBI is making every effort to remove the arbitrage, regulatory arbitrage between banks and NBFCs, but still the way they used to work in the last 20 years and how we used to work in the 20 years, I don't think there can be, in a near term, there can be a parity as far as the risk management systems in the two institutions are concerned. So whenever we are dealing with the NBFCs, we need to put better risk management systems, better processes, better controls, better cross-checking, better what we call check and balances, so that we pass on good systems to NBFCs, but we don't invite lagged system to our institutions. Like, we should give better systems to other institutions so that they remain protected and they help us do our business with better risk management capabilities. So these are all some of the things which we need to. And now we are fast moving from physical to digital. Now, when we are moving from physical to digital, and that is now going to become much more in the years to come. Now, how much we are aware about the digital implications of our transactions. Now, as far as fintech and neobanks are concerned, virtual banks, they are well versed because they have entered the financial intermediation system at a time when technology is well mature. But we were in the system when the technology was maturing, not matured. So there will always be a gap between the capabilities of fintech, between the capabilities of the banks, when it comes to operational risk, as far as technology is concerned. Because operational risk comes from three aspects, all of us understand very well. That is HR, that is human resource capabilities, and technology and systemic failures. Now, as far as systemic failures and human resources are concerned, maybe that we are little better, but as far as technology is concerned, I think we need to keep much better systems to protect our customers, to protect our people, and how our vulnerability of the digital system, and how we are able to cope with the nuances of cyber security and data privacy. These are all some of the issues which we need to keep in the background of our working, so that we mitigate the risk. I don't say that we cannot eliminate the risk when we are doing business, but we need to manage the risk and see that we do not we do not enhance the risk in the system. That is the systemic risk. So systemic risk has to be protected. If that is so, I think we need to do much more work as far as familiarization with the digital systems are concerned. Digitization we are doing, but how much we are exploring the digitization for the benefit of the banking system, for mitigating the risks, for how the firewalls are being protected, and how frequently we are doing the vulnerability tests and ethical hacking. Are we engaging the ethical hackers to see the vulnerability of our systems? These are all some of the issues which we need to keep in mind while framing our internal policies and processes. Now, as far as Basel IV is concerned, I think Mr. Rao also has told, and that works on Basel IV includes an in-depth review of financial statistics. Now, financial statistics, I think as far as public sector banks are concerned, we are still not very much deep into it. We need to harness our potentiality. We have the data of the last more than 12 years, 13 years, but are we able to mine it to enhance our risk management capability? That needs to be re-looked into. So that is what why risks are increasing, because of stiff competition, business cycles, margins are shrinking, change in consumer needs and lifestyle, because Gen X is a disappearing generation. Gen Y is a maturing generation, and Gen Z is the new customer base of the banking system. They are the people who would like to do the banking on go. They do not want to spend time in the banking system, the footfalls, but still we need to take a combination of the three kinds of customers that we have, and we need to align our services. That is why that doorstep banking has been introduced for Gen Y, Gen X people, so that they are made a little comfortable, because they may not be very much familiar with the kind of digitization that we have. So I am just throwing these issues before the audience only to just bring to your knowledge that these are happening, and we cannot govern the risk with the existing systems. Existing systems are no doubt good, but they are aligned to before 2020. Now, after 2020, how much we have changed, I think we need to introspect into that and keep these things in mind. The consumer awareness is rising as far as their rights is concerned. As far as their duties are concerned, it is a question mark. Then the ICT and regulatory changes. So I'm going a little fast because of the time that we have. What has happened after pandemic? We faced prolonged low interest rates. Now we are going to face prolonged high interest rates. So inflation, we have to work with a little more higher inflation, and input costs will keep rising for some time. Restructuring of credit facilities to mitigate the credit risk in line with RBI's dispensation, like Restructuring 1 and Restructuring 2 has been, and Kamath Committee has also given the restructuring framework, and for that the due dates are there, and then the government guaranteed loans 31st March, up to 31st March it has been extended. So these will remain with us. That means what is the indication? Pandemic might have become endemic, but its impact is going to be with us for a long time to come, for which we need to cope up with the risks that are going to come to us and that have already hit us. Negative real rate of interest, because the interest rates were far less than the inflation. Now we are somewhere around inflation and the interest rates are lining up now, and maybe that interest rate, we may have a positive rate of interest, but that is not a satisfaction at all. Inflation has to go down. There was a overhang of liquidity. Now we have paucity of liquidity because the deposits are growing in a single digit, and demand for credit is rising, and now 15% interest credit growth is there, and the credit growth demand will go up because everybody is have started doing their business with more force than it was in 2021, because 22-23 will have very active businesses because of the supportive system that has propped up in the last budget and coming budget as well. So prolonged accommodative monetary policy we have seen. Now we have passed through that accommodative policy, and now we have a neutral policy, and this will continue for some. Why I have put this on board? Because it will give us a reminder that this is the era which we have seen, but this era has passed, and now we have come to the next era. Risks in, if you go to the World Economic Forum 2022, global risks, the main risks that they have flagged: fracture of interstate relations, that is geopolitical risks, debt crises even in large economies. Small economies like Sri Lanka and all is okay, fine, but large economies may also have the difficulty in honoring their international commitments and debt honoring and things like that. And now the 10-year paper, that is the 10-year bonds yields are rising like anything, and at what pace it is rising, I think we can know from the data that is coming in the system. So widespread youth delusionment because of unemployment. Now, India is fast emerging as a capital of, is a third, of course, as far as the global positioning is concerned, as far as the startups are concerned, and we have about 100 what we call the bigger these startups.
Unicorn.
Yeah, unicorn. Exactly. Thank you so much. So that was not coming to mind. 100 unicorns, and this widespread youth delusionment, we cannot say that it is not our risk. So if there is unemployment, then that means the corporate sector is not able to absorb the and drive the potentiality of the youth. And now this kind of young India, which we are at present, like the statistics say that India is a young country, and this advantage will be there with us up to 2040. Now, these are all some of the risks which are flagged by at the World Economic Forum. Failure of technology governance. Now, what happens? The patchy way in which the technology, not about banks, I'm saying, but about if our customer is not having a robust technology, it is a concern for us. because tomorrow he will fail in the business and he will pass on the risk to us. So failure of technology governance and digital inequality. Digitization we are doing, but how much of digital literacy we are imparting? Are we able to impart the kind of digital literacy that is required? I think we need to introspect on. That is why RBI, while announcing from time to time the improvements in financial inclusion, they also harp on the fact that we need to educate the people as far as digital literacy is concerned and financial literacy is concerned. And that can only mitigate the risk of digital inequality. But if we introspect, the priority of the financial intermediaries is not about imparting digital literacy, because we have other things to do. But we need to just pause and understand and think whether risk management is about providing infrastructure or providing education to the users, or we need to balance the requirements to mitigate the risks in the longer interest of the economy. So that we need to see. Now, as far as the future risks are concerned, debt crises and others, we have discussed a lot about that. I want to just go on to the risk mitigation enablers for better risk management, because we have less time. That's why I just want to go direct to this. The 3 lines of defense. That is how the risks are managed world over, globally, as far as India is concerned. Now, the first line of defense, we always know very well, the business managers. And 90% of the employees of financial intermediaries, or even 97, 90, 95, 96% are business managers. Business managers means line managers. Now, how much they know about risk management and what kind of tools we are providing them to mitigate the risks at the grassroots level, and what kind of reporting system and escalation system that we are providing, just have a look at it. My only submission through this webinar is just sensitization about the changes that are happening, and we need to change the framework on which we are working very gradually, because all of a sudden we can't do anything, and you cannot reskill all the I think we have about 1.5 million, 1.4 million employees, 1.3 million if you want to go precisely. So 1.3 million bank employees, can they be reskilled in a day or two? No, not at all. But they need to be sensitized that the way in which we used to read the risk earlier, we need to read them much more minutely, factor them in our decision-making process, so that we are in a better position to mitigate the risk. Suppose on a scale of 1 to 10, my risks today is 6.5. If I am able to bring it down to 5.5, that's a good going. So first line of defense, how we are reorganizing, supporting them, what kind of checklists we are providing, what kind of formats we are providing, what kind of inputs they are accessing, what kind of access they have as far as the data points are concerned, what kind of external data support that we are providing them. These are all some of the aspects that need to be looked into. And the second line of defense is the risk managers. That is why RBI is very, very clear that any NBFC, even NBFC, should have a chief risk officer. If the, I think the threshold that they have fixed is 5,000 crores balance sheet size, asset size, those NBFCs which have 5,000 crores and above, they need to have a CRO. And very soon, all cooperative banks will have to have a CRO, because they are managing risk. If they are managing risk, there has to be a structure, and the structure has to be with full accountability. So second line of this, risk managers, I think we need to reskill them and make them understand what are the potential risks that are that the businesses are having, so that they keep monitoring the risks very well. And the third line of this line of defense, we all understand the audit and compliance. And as far as the audit and compliance is concerned, the first line of defense should have the ability to identify the risk. Now, you can very well understand, being in the banking system, how much our people are able to identify the risk. If they identify the risk, I can very well say that they can strategize for risk management, they can work out systems for mitigating the risk, and how they do the assessment of risk, pricing of risk, mitigation of risk, and monitoring of risk. If the line management is able to do all these five, five activities, I think we will be winning. Now, how to make them do that? I think we need to introspect into that. And the second line, they need to set the risk appetite and tolerance levels. Now, businesses, aspirations, growth, all these are to be taken into a holistic account, so that we are in a better position to actually assess how much business we can do, what is our capability, what is our SWOT analysis, what kind of people we are having, what kind of expertise we are having. If you go into the capacity building report of, I think it was Mr.
Gopal Krishnan Committee.
Gopal Krishnan Committee, yes.
2016.
Very nice, very nice. Gopal Krishnan Committee report. Now, it was very much pointed out at that time itself. I think it was 2014 or something, 2015. 2015. At that time itself, he said that you need to have certified professionals for certain kind of activities. Now, before we could embark on that and streamline that, integrate that with our systems, the external environment of risk has multiplied many-fold, and the nuances are entering day by day. So risk appetite, you can fix only if you know how much business you can do with moderate risk, or what kind of risks you can manage. What is your capital adequacy ratio? What is the extra cushion that you are having? What kind of buffer you are having? What kind of marketability that you are having? That if you want to float your bonds, or like now 81 bonds are also being floated by many big banks. But then are we in a position to take additional capital from the capital market? Because that has got a direct link with the ability of the banks to manage the risk. So risk appetite and tolerance, our risk managers should be able to put in place risk governance policy, risk pricing guidelines, and monitoring of risk. That is how data is collected, how data is analyzed, how data is disseminated. So these are the qualities which we need to build over a period of time, so that our risk decisions by the board of directors, that is board of directors are the chairman, now a non-executive chairman is the head of the board of directors, whereas the MD and CEO is the head of the management of the bank. So what kind of rapport they are maintaining, and what kind of decisions they are able to strengthen, because the risk management need to be strengthened. That you need to put right kind of questions to the line management, to the risk managers, that why this risk appetite, why not more or why not less, and what kind of systems you have to defend this kind of risk appetite, and how risk, if you have a policy of credit risk, that I want to have a 50% corporate credit, 25% retail, or agriculture 20% and others of 5%, then are we having the wherewithal to do that in a safer way, in a better risk management system, if you are not having what kind of steps you are taking to build that kind of competency, what kind of factoring you are doing for the risk pricing, and how you are monitoring, and how more than monitoring is how you are planning intervention. Because monitoring is of no use unless we are in a position to intervene in time to mitigate the risk. Now, this kind of systems we need to question in the light of the new developments that are happening. VUCA on the one side, geopolitical risks on the other side, continued disruptions of supply on the other side, lowering growth trajectory, because now the 7% growth we are thinking in India as far as our country is concerned. Many, if you see the IMF report, it has brought down from 6.1 global GDP to 3.2 or something like that. Means drastic downfall, and the alerts are coming that there could be a recession, there could be stagflation. But it is not that India is not risk proof, because if not today, tomorrow, day after tomorrow, they can travel to us. So we need to ring fence, we need to reinforce, we need to develop the competency to see that at least we are not battered under the, like what we are now doing as far as the currency risk management is concerned. Our thanks to the good buffer of forex reserves that we are having, I think now it has come to 550 billion, which was in September 21, it was 600 something, 650 and above. So it has, but the currency depreciation we could contain at 7.2 or 7.3%, when many of the currencies have breached the double digit as far as the our currency risk management is concerned. So we are doing well, but how long we will be able to do well unless we act now? And that is the need of this webinar, which has been launched now. And thanks to Mr. Rao and the leadership of the institute, that they thought that it is necessary to sensitize the people who matter for the these are the kind of things that we need to look at and reinforce our 3 lines of defense, so that we are in a better position to manage the risks. Now, this presentation I will be sharing with you. I think you can circulate among the participants if you so feel. And now, Mr. Rao, you are looking at the watch. I can very well understand. Yeah. So these are all some of the points that I wanted to share with the learned audience. That if we do the risk management in the way in which we used to do the business risk management in 2015 to 20 and 20 to 25 and 25 to 30 has to be entirely different, and we need to redefine our path of risk management and the strategies with which we work. So thank you, and very nice talking to the learned audience, and I'm sure that I could bring some points to the just to recollect, but not that we don't know these things, but to bring it in one place is very, very essential to in the larger interest of the financial sector for the financial stability and durability and sustainability. So that was the
thank you, sir, very much.
Thank you, sir.
Mahabaleshwar, sir. You can have a few words, sir, please, before we start the interaction. And I will just.
I was very happy because Dr. Srinivasa Rao touched upon all the relevant aspects of risk management. The one thing which caught my attention was that digital literacy. Earlier, we bankers were talking about financial literacy. So now it is the digital literacy on which we have to focus. Going forward, see, now almost all banks are embarking upon digital underwriting of the loans. And also customer onboarding process is also on the digital platform. I think going forward, it will be digital financial literacy. So that is the way forward for all of us. Thank you, Mr. Srinivasa Rao, for your excellent insight that you have provided on the risk management. I'm very happy that many of my executives from Karnataka Bank, they have also joined. I'm very sure that not only my bank, but all other banks are also immensely benefited. So I think it was one of the best webinars out of these three. I think we have been, and yes, webinar by webinar, we are taking this webinar to a new high. Keep it up. All the best.
Thank you, sir.
Thank you, sir.
Thank
And before we proceed further for the interaction, I would like to just thank you, sir, for very much. Because one thing I liked is that the question that you asked, how long unless we start doing it now? So wonderful, sir. It's a very, because totally things are getting changed. You said that we need different prescriptions for the risk management under the VUCA environment, and because you rightly said how the supply side disruption. We used to talk about supply side disruption in this manufacturing. Now we are talking about supply side disruption in financial sector, and that too triggered by the change in the customer behavior, and that too changed by the customer's behavior, changed by the fintechs that has come into play, using the bank's API, and how, as you rightly said, out of the unicorns that has come up, many are from the fintech area. So you rightly talked about the challenges that we are facing, the global risk, cybersecurity, identity threats, rising consumer expectation, which is also giving a total different perspective to credit risk management, consumer expectations, and the most pertinent question that you ask, are we ready with the internal process? Are our managers ready? Are our people ready? Are we teaching them? It's a very important question, and whether the banking sector as well as the regulator is moving in the same synchronized, moving in the same direction to give a prescription for this. It is wonderful, sir. And another question that I have to ask you, sir, you talked about perspective, appetite, and tolerance level. Is this crossing boundaries because of the competitions being challenged by different banks and the fintechs? So that's my question. Before that, then we will go to other questions also. If you can just answer that, sir. Thank you.
Okay, very nice. See, as far as the risk appetite is concerned, I think our MD sir is also there, so he will understand very well. I was secretary to the board, so I had the opportunity to interact with the executive directors and chairman. Simultaneously, when you have the ambitions for growth, it's good to have ambition for growth because organizations have to grow. But simultaneously, the wherewithal, that is the infrastructure on which we grow, has to be given full focus. Like if you are giving, it is just like giving export target to a rural branch. See, you can't give some kind of a job which is not available in the radius of the operating radius of the unit which is working over there. So as far as risk appetite and risk tolerance levels are concerned, it's very essential for us to understand both our capacity as far as our ambitions, so that both can be aligned together, so that just like our fiscal deficit, you see, if the fiscal deficit is 3.5 or 3.1 or 3%, then it's fine. But if it is ballooning to 10%, that means it is not doable at all. So the doability test has to be, and simultaneous focus on raising the capacity of the organization, infrastructure, and more important is the written documentation of your manuals. Nowadays, the digital manuals are in place, so you can quickly update them. Earlier, like when we were working, we used to have the standard manuals, hard copies, and we used to refer different volumes for different activities. But now everything is available at the click of the button. So it's very easy for us to upgrade them or to update them and see that the new regulatory dimensions, new policies are brought into force and brought to the knowledge of the first line of defense. So along with risk appetite, we need to create an enabling environment for that purpose. So if we can do that, then the risks can be mitigated much effectively, more effectively than otherwise. That's what is my take.
Go to some questions that is in the chat box. I would request our principal, Mr. Rao sir, to have some words and.
In fact, he covered every aspect. One aspect, though, in the slide it was there, paucity of time, environment.
Yeah.
Now that is playing a major role. I've seen that environment.
Yeah, I
and
will
social
share this.
ground.
I will share this presentation.
Thank you, sir.
Yeah.
It will have much more
Yeah.
what you call matter inside. So
Yes, yes.
Sir, we have a question from Mr. Prakash RS, who has been attending our sessions from the beginning, and you have
I
also
see.
been interacting.
Okay, good.
Will you please further clarify as to how increase in CASA is a risk?
Yeah. It's a very good question, because recently I have written a piece for Business Line about going beyond data. Just Business Line, going beyond data. See what happens. We are very happy if cost goes down, no, in near term. Like if suppose the CASA goes up, no, everybody is happy. Very good. Now, if you look at the structural liquidity mismatches, then the deposits that we were assured of earlier, like suppose the CASA is 30% and term deposit is 70%. So 70% rollover is 95% rollover. Then you are comfortable as far as the first 4 time buckets. That is the 1 day, 7 days, 14 days, and 28 days, where there is a regulatory guideline as far as the that you cannot exceed more than 5%, 10%, limits are there. So he has put a very good question that if CASA goes up, then it is a risk, no doubt, because the volatility of the liquidity goes up, and if the volatility goes up, then the fallback mechanism is not built accordingly in the system. Then you will have to borrow at a higher cost. Now, what you need to do while appreciating CASA, you will have to find alternatives for funding the gaps. Yeah, that is the risk. It is not the risk that CASA we don't want. We want CASA more. Suppose even if CASA goes to 70%, we are happy. But if it is so, then what is to be done? That action is more important. Like, what are the sources from where you can pull the sources to complement the liquidity, and you are able to meet the liquidity mismatches. If you are not able to do that, then that is the risk. It is not per se the CASA risk, but the consequences of not having liquidity of longer duration is a risk to the banking system. That is what is my argument.
Thank you,
can
sir.
Read more in my piece.
Sir,
and you can come to me also. My email ID is with the system. I think you can come to me.
Sir, thank you, sir. And
very good question.
There's another question from, there are lots of appreciations that I'm not reading the appreciation. It's already there.
No, it's fine. Thank you so much.
That's fine. With rapidly changing environment and business models, Mr. Pankaj Gupta has asked, business model and tech landscape, and also the continuously evolving, it's not better to get specialist risk managers as the first line of defense. New initiative.
So, see, depending on line management, as far as specialists are concerned, I think, see what happens, the line managers have to be on the payroll of the bank, and they have to be for a, they need to have the accountability for performance, because they take a decision and they are responsible for the decision. I don't mean to say that that the lateral recruits are not responsible. They are responsible for their job. But if there is an intermingling of lateral recruits of specialists. Lateral recruits you can have. Scale 4 you can directly recruit as a chief manager, that's all fine. But lateral recruits of specialists mingling with line management will not be very good, because they may not be understanding the actual nuances of operations, because operations is something which is business of the organization. So if these specialists are meant to what you call a guide, meant to streamline policies, meant to document policies, meant to put systems in place so that line management is able to follow. Of course, there is no bar as far as recruiting specialists in line management is concerned. You can always do that. But whether it will be effective or not, and whether it is a cost-effective proposition, and whether they would like to do that job, and whether they will mingle with the line management, these are all some of the HR issues which need to be looked into, and which need to be tackled separately.
Thank you, sir. Rao sir, it's already 9 o'clock, 9:09. Shall I close it with one question, or we have 5 to 6 questions remaining?
I have no issue so long as the dotted lines are crossed by the.
Okay, we'll take.
If you are comfortable, I am comfortable.
Sir, can we take 2 or 3 questions, sir? Rao sir?
Yeah, yes, sir, yes, sir. Yes,
Yeah.
sir.
So there's one question is from Mr. Ramesh. I'll make it short. With market competition causing pressure on earning risk, do you think agility and dynamism in risk management decide efficiency of a bank?
What is the crux of the issue?
He is telling whether dynamism and risk management decides the efficiency of a bank. With the,
definitely,
yeah.
There is no doubt. One thing we should always keep in mind. All my fellow colleagues, I always say that risk management is not an inhibitor of growth, but is a support for growth. So if you have agile risk management, business will always be agile and it will be growing. It is just like oxygen as far as the livelihood is concerned. So if risk management is good, then the organization will thrive. And if the organization is thriving, that means risk managements are very much intact and they are in place, and they are supporting the growth. So the risk management people will have to support enabling business, because we are all there only to do business, and that aspect cannot be sidelined. All risk managers are drivers of business.
Sir, thank
you.
you.
They only put systems in place, and monitor and intervene.
So we have an interesting question from Mr. Balachandra, who is the Chief Operating Officer of Karnataka Bank, CEO. He's asking, I would like to have your views on ESG. Which is redefining our priorities. Very interesting question, sir.
Sir, it's a very ESG is coming from the COP26. After that because of the climate risk, it has come, and sustainability financing and green financing and things like that. I think ESG, to start with, we need to, like if you, I think since he's the CEO, he will be able to understand the SEBI, while in 2012 has introduced the concept of business responsibility report, along with the annual report of the bank. Along with the annual report, you have to give business responsibility report. That means, are you doing business in a responsible way as a corporate citizen? So a bank is a corporate citizen, and whether it is doing the business in a sensible way, means not maligning the environment, not so taking that forward. ESG is now come, that is environment, social and governance, and this is a very good aspect to capture, which is at a very nascent stage, and we don't have much of data points on this because we have not collected the data. That's the problem, because you can't have a data which you have not collected. So right now, at least now after the ESG disclosures I think they are going to be mandated from April 23. Up to 23, it is what you call optional for the top 100 listed companies. Only top 100 listed companies, it will be made mandatory, and later on, gradually, all of us will have to fall in line. Now, as far as ESG is concerned, environment, social, governance. Now, in the business that we are doing, are we collecting any of these data points? And if not, please start this. That green financing, then sustainability financing, and like we are doing. It's not that even some time back, RBI has brought green financing. I think some of the green financing under priority sector, and maybe that now it will come with a more force as far as managing the climate risk is concerned. And climate risk can be managed only if you are aware of ESG, and you need to be what I would only suggest our fellow bankers, that we have not done much work on this because we were not very much aware. So now you start collecting some of the data points of corporate sector which are active in ESG and for which funding is being done, and where non-conventional energy related companies we are financing, green financing we are doing, sustainability financing if we are doing. Start capturing data points of that, so that over a period of time we will have some kind of rationality as far as the share of total lending to ESG sensitive companies. Because pure ESG companies, it is very difficult to get, because they do this business as well as that business. It is a mix and match, because the environmental friendly projects are long drawn projects, and their what you call yield on investments are very much staggered. So you can't survive if you do only that business. So you will have to do that business along with other business.
So we have one question.
Yeah.
During the last fortnight, the advance grown by 90,000 crores and against deposit 60,000 crores. How do mismatch in this?
That is what is my concern.
Yeah, that's what we have discussed also. Yeah.
See, when the credit overshoots your deposits, then you have CRR and SLR. Now, CRR and SLR you exclude, then how much money you are left with? The balance you will have to borrow. Now, if you are borrowing, that is why RBI says that you need to have what you call NFSR, no? That is you need to have 30 days ready liquid, high liquid assets. High liquid assets you need to have HQLA, high quality liquid assets.
High quality
liquid assets you need to have 30% or 30 days requirements. Now, if suppose you want to have 30 days requirement and you are falling short, your credit is disbursement is taking place and deposits are not coming, then what is the way out? The way out is to see that you borrow from the market, or you take the MSF, that is what is called MSF facility, 1% more interest, no? Not 1%.
Marginal standing facility.
Marginal standing facility. So you will have to harp on that. But how long you will be able to do? So the best thing is you will have to do aggressive customer service to get more deposits. Because if you are not having deposits, and if you want to go on lending, then you will have to innovate some products like we have CDs, CD, certificate of deposits. So you will have to augment your resources from other areas so that you fund your credit. Otherwise, you will be facing high, what you call liquidity mismatches and liquidity risk you will have to face. So for the information, Mr. Rao, we have one podcast on risk management in a group, that is MENTZA, is a MENTZA is a what you call it is an app. So that app one can download, those who are interested. every Wednesday for 30 minutes, we discuss on risk management, latest as well as conceptual, and there are some experts who talk on different aspects, and you can log into that, and you will be able to understand more. You can put your questions also on that.
Okay, sir.
Just
Thank you.
for information.
We have one, I think you addressed this, but still for the benefit, we have one question from Mr. S. Shankaranarayan, who is head of market risk in Catholic Syrian Bank. He was mentioning, I read one article in Business Line, wherein ALM management is crucial nowadays in the light of CASA levels. Your views on spread of banks ahead. I think you almost clarified that point. Anything to add on to that?
Yes. Yeah. See, we have to continue. That is why RBI was saying that they have brought customer focus. It is not that we are not having customer focus, but we need to do much more work as far as augmenting deposits are concerned, canvassing deposits are concerned, so that we are in a better position to market our deposit products, and maybe that we need to innovate some of the products and bring some features which will be good to the current generation of people who are keen on preferring liquidity than return. Now the current savers have more preference for liquidity than interest rate, because interest rates were very low, so people were not very much bothered. Only certain segment of people, like we have about 10 crore senior citizens in India now, and they are going to become 14 crores in the next 5 to 6 years. So this segment is now the core as far as the term deposits are concerned.
Okay, so thank you.
We need to readjust.
Okay, thank you, sir. There's one last question. Many questions are there. Maybe this one. There's a question on the collaborative lending. That's why from Gangadhar, who has mentioned this NBFC line of defense are not that highly appreciable, which looks to be risky for the banks. What's your view on this regards?
See, I think if you have read in the newspapers after the RBI has permitted banks to enter into an arrangement with NBFCs for co-lending, because they have a different kind of reach as far as the customers are concerned, and they are not having access to the savings bank deposits and other resources. So if you lend 20%, 80%, you have to take the risk, and 20% risk is shared by the NBFC. That is the structure. Now, to start with, suppose you have an advances portfolio of 2 trillion or 2.5 trillion. Trying for 1,000 crore with another NBFC is not a very, very risky. Of course, that aspect one has to keep in mind, that among the NBFCs which are better regulated, and that is the reason why RBI is bringing the regulation of NBFCs close to our banks, and that is why they have extended prompt corrective action even to NBFCs. So that is what, NBFCs they have extended.
Thank you.
Thank you,
sir. Thank you, sir. So there's some people, there's question, which is the best risk management course to be done. Some young managers have asked. Just if you can mention, that's all.
So,
Sir, thank you very much. I am a regional head of Karnataka Bank, Kolkata. It's been a very good presentations on risk management. Thanks to our MD, Mahabaleshwar sir, for giving this opportunity to attend.
Thank you very much, sir.
Thank you. Thank you so much.
Thank you.
Thank you, sir.
Thank you very much, sir. It's a wonderful.
Thank you very much.
Thank you very much.
More. If there are questions, you can email to me. I will be happy to deal with that.
Great, sir.
Sir,
It was
questions you can email to me.
That app, can you please explain that app?
That is Mentza, MENTZA, is a podcast. Is a podcast site. It is an app. If you go to that app downloading,
MENTZA.
MENTZA.
Okay, sir.
So you can chat with us, and there are certain experts who will be talking on that. So I have initiated that for the benefit of all the students and bank employees.
So though,
Thank you so much,
very much.
Thank you
so
very
much,
much, sir. It's
Thank
very,
you
very
very-
informative and useful.
Thank you very much, sir. Thank
So,
you.
Can I take leave?
Yeah, sir. Thank you
Sir,
very much, sir. There is a
thank you,
formal,
sir.
formal vote of thanks, but sir, there are lots
Yeah,
of questions,
formal vote
but
of
we have to make a hard stop. Sorry for that. We have to hard stop for this because without it can go along for another 1 or 2 years. I know.
So actually, each aspect that we discussed requires one separate webinar.
Yeah. So we are making a hard stop to this, Ms. Prinsik, and you just make a formal vote of thanks for this. Yeah.
Yes.
Thank you, Srinivasa Rao, sir. You gave us all a lot of valuable inputs, addressing all of us with such a cheerful disposition. Thank you for patiently answering the questions posed by all our participants. Thank you, everybody. Thank you, Mahabaleshwar, sir. Thank you for addressing us at a short notice. Thank you, Rao, sir. Thank you, Ajayan, sir. Thank you for organizing this webinar. Thank you to all the participants who joined us on YouTube as well as on Zoom. Thank you, everybody.
So my thanks to Vriddhi and then our Rao sir for initiating this, and my best wishes to the entire team for organizing this.
Thank you.
Well done. Well done.
And thanks to
Thank you.
Mahabaleshwar sir.
Sir,
Thank
we
you.
will take this forward. We'll make it an important webinar of the nation, sir. All the
Yeah,
bankers
yeah.
will look forward it, sir. With the
Yes,
support
yes,
of Mahabaleshwar sir, Rao
Yes.
sir, and all of you will make it, sir. Thank you very
Yes,
much.
thank you.
Thank you.
Thank
Can
you,
I-
sir.
Thank you very much,
Can I
sir.
log out? Thank you, sir. My Mahabaleshwar sir.
Thank you. All the best.
Thank you. Can I log out, sir?
Yeah.
Yeah.
Thank you, Sri Vishnu sir, who also joined. Many of the faculty also have joined. Thank you all. Raina sir and all the faculty, those who have joined. Thank you very much.
Thank you, sir. Thank you.
Thank you, sir. Thank you, everybody.